Hi, I'm Michael Landsberg, Chief Investment Officer of Landsberg Bennett Private Wealth Management. This is our quarterly update for the first quarter of 2025. We just finished 2024 and it was an excellent year for the majority of asset classes. Large cap stocks did very well, mid cap stocks did very well. Even small caps were up this year, which has been a novel change. Overall, what happened during the year was as we expected. We thought interest rates were going to be lower, but not as much as the market. About a year ago, interest rates and many forecasters thought the Fed would cut rates 6 or 7 times. We thought you'd see probably 3, and that's actually closer to what you got. Interestingly enough, what's happened in the last couple of months, as the Fed has lower interest rates have actually gone higher. The bond market has kind of looked at the Fed and thought, we don't really believe what you're doing, and we're moving in a direction that we think the bond market's going to be. We think that's actually more apropos for what's going to happen in 2025. Right now, the Federal Reserve is talking about lowering interest rates, or at least the market expects 2 interest rate cuts this year. We don't think you're going to get any. Part of that reason is we think inflation is back. I say that with a caveat. I don't think it's back to 21 and 22 levels where headline CPI got to 9%. I don't think it's going to go to that height. But we do think it's going in the direction that not the Fed is expecting it to go. What we saw in September was the headline CPI kind of at the bottom, if you will, at 2.44%. Our models looked at basically at 6 months, and we saw 6 months of consecutive increases in CPI. We're now actually doing this in January, and the December data is about to be reported, and it will be higher than October. We think you're going to see 6 more inflation increases basically until June. Again, anything past June, my crystal ball gets a little bit cloudy, but what we're looking at is 8 or 9 consecutive months of CPI going higher. Now, does that mean we're going to be back to crazy prices? No. But it does mean it's the opposite direction that the Fed thinks. This prediction, if you will, our forecasting, was with oil staying pretty much the same. Now, oil in the last couple of weeks has spiked higher. We think that's actually to put more upward pressure on inflation, not downward pressure. Now, is that necessarily a bad thing for stocks? Not necessarily. We're in an environment right now where we think stocks are going to continue to go higher because growth is going higher. We saw S&P earnings last year up 8% year over year. But NASDAQ earnings were up 20% year over year. And as you know, if you've watched these videos before, earnings drive stock prices. That's my mantra. It's always been my mantra. Now, it's not a direct correlation. If earnings are up this quarter, it doesn't mean stocks are going to be up this quarter. But over time, if your earnings keep going higher, your stock prices will end up being higher. That's just the way math works. So we think this is a good environment for stocks. Even though inflation on the margin is going to be heading higher, we think you can play that by owning stocks that will participate and higher inflation. Those would be more the growthy names like technology, discretionary names, and people that have some pricing power. So for example, there's areas of the economy that people want and they're in high demand. We think those are going to continue to do well. So we're excited about that part of the market. In the bond world, however, got to be really cognizant of the fact that we think rates are going to stay higher for longer. And what does that mean? That means the short end, the shorter bonds that we continue to own will be a good place to be. We'll get paid good returns without taking a lot of risk. The concern for many is if you bought long-term bonds last year, you're down. And that's an area that obviously we don't want to be down in bonds. It's an area that we certainly look at bonds as being a life jacket, if you will, for choppy seas. And for us, it's been that. We have a lot less volatility than the bond market simply because we have shorter, higher quality bonds, and we're not willing to take that risk on the bond side. It's one thing to take risks in stocks because we're expecting to get paid for it. But in the bond world, we don't want to take risks because we're not going to be compensated for it. So we've continued to be short in terms of shorter maturities, getting paid a good rate of return without taking a lot of risk. We also think that will continue to be a positive is going to be having alternatives, which is what we've owned for many of you for years and years, is having the golds and the US dollars and the commodity complex because they give you a return that's different than stocks and bonds. Too many people in the United States have a portfolio that's basically 60% large US and 40% bond index. And the problem is they miss a lot of the idiosyncratic returns in the market. And what I mean by that is last year gold did very, very well. The last couple months, the US dollar has done very, very well. They do this and they have good returns without the same level of risk that you get in stocks. The idea of owning these is what institutions and large endowments do, is to smooth out your ride over time. And so that's why we own roughly 10% of that allocation is to these alternatives. And they've done very well for us. We look at them as basically a differentiator from owning bonds. So instead of having that 60-40 mix that so many people have, You may have 30% in bonds and 10% in these alternatives, which will give you a different return profile, lower the risk, but also give you diversification just more than having stocks and bonds. And we think that's important. Real estate would also be something else that's in that mix. As we continue to diversify, diversification is very important. If you look in 2023, stock market went up, but the concern was seven stocks did the majority of the heavy lifting. Well, in 2024, it was maybe 10 or 15 stocks did the majority of the heavy lifting. So it's broadened out a bit, but still not as enough. Our concern is there's a lot of risk in just owning those big names. So we continue to think you want to diversify. We want to add more and more strategies. So as you know, we've got 7 strategies that we have all together. The goal would be is to have as many of the 7 as you can. Doesn't mean they're equally weighted, but the idea is to have some of these other strategies that don't necessarily just own those big 7 or 10 or 15 stocks. Because at some point, they're going to go down. We don't know when, and we can continue to be long-term positive on a lot of those high-quality tech names that we've owned for so long. But it doesn't mean that you can't diversify a little bit to kind of trim your risk. One of the things that we do that's worked out very well for us over time from a risk standpoint has been we rebalance your portfolios. That happens in January, and it happens also in July. But the idea is we take a stock that's done really well, and let's say it's up 100%, and at the beginning of the year it was 4% of your portfolio, now it's 8%. We're going to trim it down to 4%. And the reason we do that is over time we believe it will go higher, but there is increased chances for it to go down after it's had a big run up. So when we look at risk, one of the few things that we can control in portfolios is risk. So if I continue to let winners win, and that 4 becomes 8 and the 8 becomes 12, and then it loses 40 or 50% of its value, that's a huge decline in your portfolio. If we're trimming winners as they go higher and still keeping that position, what that means is we diversified, we've trimmed high and added low. The idea of buying low and selling high doesn't really work because nobody can get the work done twice. What we've realized has been if we trim after things have done really well, that seems to lower the risk in the portfolio and will add to something that we really like when it hasn't done particularly well. And we've seen that in the last couple of years. In 21, after tech had a great year, we trimmed our tech exposure down. In 22, when tech was a train wreck, we added more exposure at the beginning of 2023 to take advantage of that. In the last couple of years, as tech has done well, we've trimmed it. Think of it like a rose bush. You're doing a lot of that pruning with the idea is we're going to get more roses over time because we're constantly pruning it and making sure that we're trimming it when things have gotten a little bit overgrown. And that's the scenario that we're in now. We've done these rebalancing, we've lowered risks in portfolio with the idea that we think we're still going to have a good 2025. A lot of things on the horizon with the new administration. We think the US dollar is going to continue to do well. This is the first time I think in my lifetime I've heard Washington talk about cutting expenses. I mean, we typically know our money goes to die in Washington. Who knows what they do with it, but the taxes are higher and higher and the spending gets higher and higher. This is the first time I've heard anybody really talk about we're going to cut expenses. We're going to look at where the inefficiencies are. If that happens, the dollar should continue to do well, because that's going to be a scenario where a stronger dollar is going to benefit from lower debt, lower deficits. So that's a positive that we think is going to continue on for the year. Now, does that mean every sector is going to do well? No. There's areas that we all know, defense and healthcare come to mind, that there's a lot of fat. We all have heard, I'm old enough to remember the $435 hammers that were talked about by the Department of Defense a long time ago and the $200 toilet seats. There's a lot of stuff that gets spent in our government that's nonsense. So I think there's a lot of companies that are Fortune 500 companies that make a lot of money selling nonsense to the government. So places in defense we're probably going to look at and say, do we really want to own as much? And we've already started that process to trim after the election, as well as some of the healthcare. $1,000 a month in drug payments, I don't know if those are going to continue. Now, I'm not saying I'm going to cut them to $10, but if you're charging $1,000 and now all of a sudden, the government starts looking at how much is Medicare paying for these, you could see some pressure in some of the healthcare names as well. Also with some of the insurance reimbursers, specifically healthcare insurance. So there's areas that we're going to want to avoid or lower our exposure to just given the kind of the newness of a new administration. We also think that the thought process around tariffs is overblown. President Trump was in office once before, and in 2017 he enacted some tariffs. I think a 17% tariff on some goods that came in from China. The Chinese currency declined about 14% after that, so we didn't see much. So I think a lot of this talk about inflation being re-energized because of the tariffs, I think is political nonsense. We'll see what happens, but if I go by the track record of what had happened in the past, higher tariffs meant the Chinese currency devalued, which at the end of the day meant the products that came in were not much more expensive. I do think a lot of the tariff talk is saber rattling, which basically is a way for Trump to be able to say, this is what I want to do, and be able to let people know. And ideally, people will kind of cooperate and be able to negotiate and not have to go the route of tariffs. Because tariffs traditionally don't work. But the idea, because we ultimately pay for that, but the idea of using them as a big stick to kind of move some people around, I think is right in Trump's wheelhouse. He likes to be the bully, and I think he likes to use the big stick. And this is a scenario where I think if we're investing with that idea, we may be able to actually take advantage of that. It's one of the reasons we don't like a lot of the emerging economies right now that export to the United States, because we think they're going to go after some of those. They're going to go after some of the deals that Trump thinks is unfair, and I think that's going to ultimately be bad for their currencies, bad for their stock markets. Good for our country and good for our stock market. So we still like a U.S.-centered policy. We still like having more of our money in the U.S. than anywhere else. Still want to have a little bit of exposure to international, but most of our international exposure is not emerging. It's big developed stuff that we have all over the world that a lot of you have in your homes. That's the stuff that we should have. Continue to exercise to have our small mid-cap portfolios done very well. The small cap market is stuck. If you go back and look, November of 21 to today, it's about the same. So that means in the last 3 years plus years, you've made no money if you bought the Russell 2000 index. Our portfolios are up a lot, in comparison to that in terms of the small cap. We do that because of better stock picking. About 50% of the Russell 2000 stocks, so smaller companies, don't make any money. 100% of the stocks that we buy in our small cap portfolio make money because we only have 25 stocks. We can do a little bit of homework to say, I don't need to own 2,000, I can own 25 that make money, that are in good parts of the market that we think are going to do well. So we continue to think diversification is important. We can continue to think you don't want to have all your eggs in the large growth bucket, even though that's our favorite area. That's why the rebalancing is important, to have some large value, to have some small and medium companies, to have some international, because at some point the music is going to stop and we will have a pullback. And again, that pullback will be pretty sharp because so many people own the sectors. That's again the reason we rebalance, is we rebalance to lower the risk across asset classes for everybody. Keep in mind your longer term goals and objectives. But by doing that is not getting too caught up in what's working today, what's working tomorrow. We want to look at what's going to work over the next 3 to 5 to 7 years, but making sure that we're kind of staying on that path. With that being said, we appreciate the trust and confidence you show in our team. We enjoy working with so many of you. Looking forward to a healthy and prosperous 2025. Thanks again.